Before we can get into the nitty-gritty of technical analysis and trading strategies, we really need to take a moment to understand and to think about how price actually works and how the markets work. Because once you understand that, you'll find it a lot easier to be able to stay with trades for longer, to be able to identify the right setups that you want to take as well. Because a lot of the time I see that rookie traders, they end up getting into trades that they shouldn't really be in the first place. And if they understood how the markets worked and they understand it and they understood the dynamics of the markets, then they actually wouldn't be taking some of these trades to start with and hence be saving themselves a lot of money. So what we're going to do is we're going to take a few minutes just to look at a chart and just talk through what's going on in the chart at any one time so that when you're doing your analysis, you have a little bit of an understanding as to where the high probability setups are going to occur. So we'll take a look at we've got the Aussie New Zealand chart in front of us right now. So why don't we start off by taking a look at this, and let's look at the 4-hour time frame. Okay, now time frame doesn't really matter that much. You'll see this stuff play out on any different time frame, and that's one of the wonderful things about trading is that price patterns that you can pick out and you can identify on something like a 5-minute chart or a 15-minute chart are just as applicable on a 4-hour chart or a daily chart or a weekly chart. So you can apply the principles that we're showing you to literally any time frame of your choice. Obviously, the higher the time frame you use, the less time you're going to have to spend in front of your screen. And in some cases, the more reliable the setups are going to be. Because if you think about it, if you look at, let's say, a 1-minute time frame, for a particular bit of price action to occur, nothing really has to happen in the markets. It's a bit arbitrary, in my opinion, anyway. Whereas if you look at something like an hourly time frame or a 4-hour time frame, you can really see what the market is trying to do because it plays out over a number of different bars. I mean, even if we look at, let's just say, the hourly chart to start with, if you're going to look at any significant piece of price action, it's going to take place over 8, 10, 12, sometimes even more, 20 different bars of information. So you've got a good day's worth of information there and a day's worth of price action from the market participants. Whereas if you were to look at 20 bars on the 1-minute chart, it means nothing. All it means is 20 minutes has elapsed. But anyway, that's my little rant on the different time frames. You can use this on any time frame you like, but obviously remember the techniques that we show you will be a little bit more effective on the higher time frames. But back to the subject of this video, we're talking about the market dynamics. We're talking about the way the markets move. If you look at any charts, all right, on any time frame, you will see that you never ever have the market move from A to B without stopping in between. In fact, let me zoom out there for a minute. So if you look at this chart here, the market moves from this point at one spot 0327 all the way up to one spot 1018. So it goes a fair old distance, a good sort of like 700 plus pips. And it does that begins in February and then eventually it ends in the middle of March. You've got a good 700 pip move there in about 6 weeks. But it doesn't just go from this point to this point here. You get pullbacks in between. So the market moves up, it pulls back a little bit. It moves up again, it pulls back a little bit. And then it obviously changes direction. It starts to move down. And then you get another pullback. All right. So what you need to understand is that you're never going to, occasionally if you get central bank intervention or something like that. But for the most part, you're never going to see just like this one-way traffic. There are always going to be pullbacks in a trend, which provide us with opportunities to get involved in a trade in high probability trades in the direction that the market is moving. Okay. But let's think for a moment what these pullbacks actually are, because that helps you have an appreciation for where the price is going to go next. Typically, a pullback is not going to retrace 100% of the move. Okay, so we've got this move going from here to here. It would be highly unlikely that the pullback would then move all the way back down to this point here. If it did that, that would be telling us that the trend isn't very strong, because what you want in a nice strong trend is that you want, and let's take this one for an example. Let's zoom in for a little bit. So we've got an uptrend here. Okay, you've got the market is moving up. It pulls back. It moves up, it pulls back. Now, what has to happen for the market to move up? you have to have the buyers being more aggressive than the sellers. So the buyers, there needs to be a lot of demand for a currency. So whilst this is moving up, up, up like this, that means that buyers are accumulating positions. Now, what you want to see in a trending scenario is you want to see relatively shallow pullbacks like this. And typically you don't really want it to be more than 60% of the previous move. So if this move was all the way up here, you don't want to pull back to be more than 60% of that. You want it to come in somewhere around here at the max. And the reason for that is that you don't want to see the buyers relinquish control, right? Whilst the market is moving up at the moment, you can see the buyers are in control. During the pullbacks, you want it to be nice, orderly pullbacks, because what you want to imagine happening is that it's not that there's a massive wave of sellers coming into the market. Actually, all it is all of the people that were making money, all of these buyers here, are just taking a little bit of profit on their positions, right? And why wouldn't they? They've made all of this money. They want to book some of their profits before the next move up, which is why when you look at charts like this, you want to see a nice sort of swinging scenario. If you get the market move up here, then all the way back down again, that's telling you that there's something wrong. You want to see it, and let's see if I can demonstrate with a trend line in here. You want to see it so that ultimately, oops, get rid of that. So that ultimately you see the market, it moves up like this. Okay, then we get a little bit of a pullback like it does, exactly as we're seeing here, and then we get another move up like so. What you don't want to see is you don't want to see the market move up like this and then a massive pullback that comes all the way down here. Because then if we have that, we don't really know what's going on with the market, right? If the market pulls all the way back down to that point there, then we're where we were to start with. Now, what does that tell us? Does that tell us that the buyers are in control? Absolutely not. Does it tell us that the sellers are in control? Well, yeah, maybe a little bit, but we have to remember that this point down here is where the buyers took over in the first place. So could it be that you're going to find a wall of buyers down at that support level? Who knows, right? That's why when you're looking to get into trades, you want to take the highest probability setups, which means you want to get involved in the trades where you can see who's in control of the market. The market's only going to do three things. It's going to trend, it's going to reverse, or it's going to go into like a range bound consolidation type market. All right, and you can see that on all of the different pairs. You see, so for example, here we can see that we've got some trending price action. This up move here is trending upwards. If we move to the right, we can see that it's a bit toppy. So the market moves up here, it pulls back a little bit, pulls back again, tries to get above that previous high, doesn't quite manage to do it, and then starts to move down. So that's indicating to us that we've got a bit of a reversal in there. And if we've got reversal price action, then obviously we want to be taking a trade in the opposite direction of the trend. And then obviously you've got this final phase, which is sort of like a consolidation phase. That's when the market doesn't really know what it's doing at all. The highs aren't higher than the previous highs. The lows aren't lower than the previous lows. It's literally just going sideways like this. And this is a completely different strategy you want to execute there. But the point is that if you can start understanding these different market conditions, if you can understand the dynamics, you can understand how the markets move, then you can apply the right strategy for the right market condition. You don't need to be one of those new traders, one of those rookie traders that are like, I'm only going to trade this way. I don't care what the market is doing. I am going to be buying with the trend, damn it. And there is no trend there. And you still try and buy it. Then you lose money. And then you wonder why. So yeah, I won't dwell on this too much, but hopefully you get the point. What I'd recommend you do now, as with all of our tutorials here, is basically go away, take a look at a chart and try and identify these things for yourselves. I promise you, it won't be wasted time. This concept here alone is going to help the rest of your trading. Okay, I have no doubt about that. So thank you very much for watching, and I'll catch you on the next video.